Okay, in this video we're going to review the HL30 on the Euro-Yen. This is actually a trade that we took with the trade copier, and I want to walk you through the specifics of this particular trade because it's a little bit different. If you're using the HL30 on the euro dollar and the pound dollar, we always use a 20 pip target and a 20 pip stop loss. But when we use the HL30 on the euro yen and the pound yen, we always use a 40 pip target and a 40 pip stop loss. And the reason is that the yen crosses can move a lot further. So let's go ahead and start off this particular trade, where it began, what it was actually a result of. And you'll know, if you're following along and you're trying to learn the HL30, you know right away that the HL30 basically is looking at the previous day's high and low after the 5 o'clock rollover period. Now this actually occurred on Friday, so this is actually Monday open, but either way it works just the same way. What we're basically doing is waiting for that rollover period and then trying to identify the high of the previous day. Now again, there are some very specific times to not use this strategy. You really have to be aware, and knowing when not to use it will help you improve your performance and your winning ratio using this strategy. Remember, there really isn't a perfect trading technique that's going to work consistently forever. It doesn't work in every market environment. You really have to get to know that particular trading strategy and then know when not to use it and know the best times to use that particular strategy. That's what's going to help you improve your percentage, your winning ratio. So again, watch some of those videos that will explain when not to use the HL30. But this is a perfect example and a perfect time to use the HL30. So here we have Friday's high, or the previous day's high, 135.32. Now we need that 10 pip range, right? We know that price has to approach either below the resistance point within 10 pips, and it cannot go beyond the resistance point from the previous day beyond 10 pips. That's that 10 pip range. It's really a 20 pip range if you look from the top to the bottom, but I'm talking about 10 pips above or below the previous day's high or low. That's where price needs to approach. And here, when the market opened, it turns around and comes right back up and tests the resistance from the previous day, and then it doesn't go any higher than 34. With a high a previous day, or that cutoff period of 32. So here we wait for a reversal candle, and there's the reversal candle right here. Now this one gave us an entry of approximately, on that close, of 135.13. That's the entry on the reversal candle. And remember, the indicators have to line up perfectly. We're using a CCI and we set it at 14, and we need the CCI reading on that closed candle, that one right there, the one that gives us the signal. The CCI reading has to be lower than the previous day's spike high CCI reading. That's what's most important. That's what confirms this signal candle. Now in this case, obviously, the close was right at the high, but it doesn't always work that way. Sometimes in the middle of the trading day, you'll see the spike high or something to that effect. Whatever the case is, you have to be able to identify the high of the previous day, in this case since we're trading it back down, and then determine the reading of the CCI, and then look at the closed candle that is giving you the signal, the reversal signal candle, and then making sure that the CCI reading is lower on the signal candle compared to the previous day's spike high. That's what's important. That's what gives us that confirmed reversal signal candle. So then we get in on the close of that candle. Now again, I mentioned we're using a 40 pip target and a 40 pip stop loss. So let's take a look at this. We're going to move this out just a little bit further so you can see there's the entry, 135.13. Here's the stop back up here at 135.53, and then there's the first target, 135.73. Now I mentioned first target. All of these techniques can be used where you could trade them straight to their first target and their only target. But I do recommend scaling out, and it's always more effective if the trend continues or resumes and it goes a lot further than you normally expect to maximize the move in that possible trend or that possible trade. And that's one of the reasons why we scale out. And the way we scale out, if you can do so, if you're just using one lot and you just want to use one lot, you can easily trade it to that first target. But if you can take off, let's say, half of that position at the first target, you would then look for an additional 40 pips. And once price reaches the first target, then we move the stop loss to a break-even stop loss. So if the entry is 135.13, let's say you had a 2 pip spread, if price pulls back up to 135.11, After it hits the first target and you've locked in some of the profits, then the second half of that position would be closed at zero. You wouldn't earn anything on the second half of your position, but you would earn the 40 pips on the first half of your position. And the reason is that if it continues on the second half and it doesn't stop you out at break even, you earn 40 pips to the first target, and then you earn an additional 40 pips to the second target if it continues. Now the second target is all the way back down here at 34, which is right here. I put that right there. Now, let's continue on. Let's see exactly how this played out. And every single time, the HL30 is going to look a little bit different. It's not always going to follow the same structure. In other words, the structure, I guess I should say the structure, but the pattern is what I'm talking about. The pattern is going to be different because of the price movement and the activity and the type of environment that we're in. That's what's going to determine how long it actually takes before it reaches this target. Any kind of economic data that's behind a move like this, every time it's going to look a little bit different, but it's the structure. Remember, we're looking for a 40 pip target, a 40 pip stop. At this point, once you get into the trade, it's either stop or target. It's almost like an on and off switch. You get into the trade, you know exactly what your risk is, you know exactly what your profit target is, and that's it. You just leave it alone. If you don't like this trade, or if you don't want to trade and use a 40 pip stop loss, then trade the HL30 on the euro dollar or the pound dollar, which then gives you a 20 pip target and a 20 pip stop loss. So let's continue this one out. You'll notice this spike low here. It moves really nice. It takes a few hours for it to actually start to move back in that direction, but at no point do we get stopped out. It just sort of retests the previous resistance point, and then it comes down as low as 86. It's not our target of 73, so we leave it alone, and then it comes back down one more time and reaches 77. We don't close the trade, we leave it, because in most cases, if this trade is done correctly, it will reach that 40 pip target. So then we just leave it alone. The structure is still intact. There's no reason for us to adjust this. There's no reason for us to panic. However, during the trading session, it did pull up pretty far. Actually, more than it did after we got into the trade, and we had to sit through this retracement. And then it actually pulled back even further, back up here, and actually reached this 32 level, 135.32. But again, at no time did it ever really get too close to that stop loss of 53. The structure of this trade is still intact. Now, I mentioned earlier, the pattern that you actually see is going to vary. It's going to be different, and it's going to look different every time you use it, because it's really depending on economic data and, again, the market environment. What we've seen over the past few weeks and the past several months, this particular quarter has been a very interesting quarter in itself, meaning that there's been a lot of consolidation, a lot of economic and global factors that are having an effect here on the currency markets and markets in general. And again, it's going to determine how long price takes for it to actually reach that target. I don't put a specific time as far as how long I'm willing to wait for a trade to reach its target in most cases, unless I see a trade is going to fail. The structure of this trade remained intact, so I continue to hold on to the trade, and then it eventually comes back down, and here's where it hits the first target. Right there, you can see that that's 134.73. Once it reaches 1.3473, we then, if you want to scale out of the trade, you would then take part of the profits, however you prefer to do it, here at that first target, and then set the stop loss, move it from 53 down here to, let's say, again, as I mentioned, if you had a 2 pip spread on this one, you would move it to 135.11. So if price then pulls back up after you've already locked in 40 pips profit here, or approximately 40 pips, if it moves back up to 11, the second half of your trade would be stopped out at break even. This spike high right here only went as high as 7. So you would still be in this trade, and then it comes back down here, and it's sitting right around that 80 psychological level, looking like it's going to break this low and possibly even test this support level here at 134.47. These are possibilities, and this would be our second and final target. If it reaches that second and final target and you scale out, what you've effectively earned is 40 pips to the first target, and then an additional 40 pips to the second target. But you'll notice that from the entry to the final target is 80 pips altogether. So there's 80 pips on the second half of your position, but 40 pips on the first half. That's 120 pips effectively. That's the profitability in a trade like this. But I have to state that it doesn't always reach the second target, and that's why it's very important to lock in profits always at this first target. If this trade's done correctly, it will almost always reach the first target, regardless of whether you're using a 40 pip target on the euro yen or the pound yen, or you're using a 20 pip target on the pound dollar or the euro dollar. Now, I'd also like to point out that what often happens in a situation like this, and I get myself into trades like this very often, where I trade an HL30, let's say off of resistance here, and then what ends up happening is I complete my HL30, but then later on a continuation breakout to the downside actually develops, and then I get a second entry opportunity to trade it as a continuation breakout trade. And the continuation breakout trade then pays me even more on this currency pair. Whenever I trade the continuation breakout trade on the euro yen, I'm always using a 150 pip target. I do recommend scaling out at approximately 80 or 90 pips, but it's always a 150 pip target, and that's a different technique altogether. I'll explain that in another video, but that's how we traded the HL30. Remember, it doesn't always look like this. In most cases, it doesn't take this long, and in most cases, we don't see multiple retests that continue to just bounce around for hours and hours and hours at resistance. That isn't usually a very common scenario. However, again, the structure remained intact, and there was no reason to close this trade out. Remember, once we get into the trade, as I said earlier, it's like an on or off switch. You get into it, you know exactly what your risk is, you know exactly what your reward is, and it's either stop or target at that point. You just leave it alone and let it go. And it's the same thing, same structure when you use it on the euro dollar or the pound dollar. And that's one of the biggest advantages of using a technique like this, is that, again, before you even get into the trade, you know what you're willing to risk and what your reward is. So you know which one you're willing to actually participate in. Again, if you want to use a 20 pip target and you don't like the 40 pip target and the 40 pip stop loss, trade it, the HL30, on the euro dollar and the pound dollar. But again, this one worked perfectly, reached our first target, and you'll notice it actually comes back down again and tests that level again. Not uncommon to see bounces like this and for price to wave around like this all of the time. That's how we traded it. And again, we only use the indicators as confirmation on the signal candle. I know that after I get into the trade, the indicators are going to change their shape. Often I get the question, if we see the indicator start to reverse and come back up, should we close the trade? And again, this is based on price action, not as a result of the indicator. The indicator is only confirmation of the signal based up here on price action and the candle pattern. The candle pattern here is based on price action. That's what's really going to determine this move. And these targets, I spent many years developing this strategy, and these targets were proven over and over to be achievable based on average daily ranges. And again, these consolidation ranges. Again, that's why I use a 40 pip target for the euro yen and the pound yen, and then a 20 pip target for the pound dollar and the euro dollar. I knew that they would go and fulfill that distance based on each currency and based on the daily average ranges.